We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
There's a place where the gold runs deep. And when you strike big. Meet Nevada's fastest growing mineral claim holder in the heart of elephant country. Visit nevadaking.ca to follow the story.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodjevics. Joining me today is Simon Mikhailovich. He's a contrarian investor, entrepreneur, and founder of the Bullion Reserve. How are you today, Simon?
Very well, thank you.
Great to have you. So one of the quotes that I found very, very interesting that you've brought up a couple times was that the left side of the balance sheet has nothing to do with the right, and the right side of the balance sheet has nothing left, but they are equal to each other. So accounting-wise, we are fine. And this, of course, was said by Jacob Frankel, the AIG vice chairman. So how does this apply to our situation today? And give us some context on why you kind of bring that quote up.
Well, I mean, that reflects, first of all, the context for the quote was, he said it when AIG went bust in 2008. And so I think that very much applies to the affairs of the world and government balance sheets today, meaning that, you know, the liabilities far exceed the assets. The equity has negative value, but because accounting-wise, it's all valued, it balances, then therefore it's all fine. So yeah, we're fine on paper, but in reality, we're bust. Now, why do I say that? I mean, it's you interview a lot of people, and I'm sure that there's nothing I'm saying here is revolutionary, but to the extent that debts are claims on future cash flows, I think it's pretty clear by any rigorous analyst or even marginally rigorous analyst that it's impossible to meet future payments on debt out of cash flows, or I should say that the claims on future cash flows exceed the value of the cash flows. That's why the rate's a zero. So what does the rate of return of zero means? It means that you give your money to somebody and they will give back to you the same amount or less in the future. That puts economics 101 on its head. But that's the world we live in right now. And I would say that it's really only enabled by technological advances and digitization and other things. But in the real world, this has not happened before. And there's a reason. The rates are at 5,000-year lows. The asset values are at 5,000-year highs. I don't know. I mean, when I went to business school, they taught me to buy low and sell high, not to buy high and try to sell higher. That's a different approach to investing. But that's kind of where I think we are. And so from a macro standpoint, all that means is that if the assets and liabilities do not match, meaning that liabilities cannot be paid off in real terms, that means that the assets are overvalued. Mm-hmm. And because every dollar of debt is somebody's asset, that means that whatever assets are on the books are overstated. So people talk about Jubilee, they forget that if you write down the debts, you also have to write down the assets. And whose assets are these? Well, pension funds, insurance companies, 401ks, that's whose assets these are. Savers. And so I think that's where we are.
So in your TED Talk, Simon, you talk about the DCF, or discounted cash flow formula, and you kind of glossed over it there. So why don't you tell us more about that simple rule and the inverse relationship that it has between interest rates and cash flow producing assets?
Of course. From a financial professional standpoint, or financial science standpoint, value, quote unquote, or the price, or whatever is transactional value exists for any security that is based on its promised future cash flows or returns or whatever paybacks, there's a formula. It's called discounted cash flow model, where it's a formula that discounts into the present the value of future money. What is it worth today? As simple as that. And the way the formula works is that it has three components. It has what's the value today, how much money am I going to get tomorrow, over what period of time, and what is the rate of interest or the cost that I charge for lending my money for a period of time that is involved. So discount rate. So the way the formula works is the lower the discount rate, the higher the present value of future money. So if the value is 0, then today's value of future money is as high as it can be. Now, I realize it can go to negative for a period of time, but that's okay, fine. Then it gets even higher. Then today's value is even higher. So if the rate's a 0 to negative, then all that means is that today's value of future money is as high as it has ever been and as it can possibly be. That's simple as that. Mm-hmm. So if it's as high as it can possibly be today already, then how are you going to make money over time if you're already paying as much as it can possibly ever be worth? That's just because somebody would pay more later for reasons having nothing to do with fundamentals, just because they want to pay more later. Mm-hmm. That's not investing. That's called speculating. And so that's the difference.
So let's crystallize how much purchasing power the U.S. dollar has lost in the last 100 years, as you're talking about, the value of things going down. So how much was lost over the last 100 years, and especially in the 1970s, and the picture we're now facing looking forward from this?
Well, I did this. Well, the short answer is 95, 96, 90 plus percent. Mid 90s% is the loss of purchasing power. The easiest way to illustrate that is I found a picture. In New York, there's a famous Nathan's hot dogs. It's a company that's been around since the early 20th century. I found a picture from the early days of their stand and the price of their hot dog then, and the price of, and they're still around. So we know what their price of the hot dog is today. So hot dog to hot dog, the dollar has lost 95, 96% of its purchasing power. But you know what's interesting? An ounce of gold today buys about the same number of hot dogs that it did 115 years ago. But the dollar only buys, 95% less. Mm-hmm. So there's your comparison.
So I'd like to move to talk a little bit about the liquidation event and where in your opinion it could start, and maybe let's add the context of why central banks are willing to do whatever it takes to avoid this.
They don't have a choice. You have to understand me. They're political constructs. They're on a goat path. The goat path is going up. There's a whole army behind you in the goat path. You can't turn the army around. You really either you tell everybody behind you, let's jump off this cliff and see what happens, or you just keep going and hope that there's something somewhere ahead of you. Maybe there is, maybe there isn't. But what choice do you have? So they're essentially committed to a path, and no politician would ever slit his own throat in this way that I'm describing, because to say right now that this is it, we need to reorganize the system. We need to restructure the obligations. We need to devalue the debts. We need to devalue the assets. We need to reset the system onto a solid financial footing, is a political suicide. And not only a political suicide, it's a potentially a major social and political disruption. Mm-hmm. Because if everybody suddenly realizes that their pensions aren't worth anything, or a lot less than they thought, and the savings are wiped out, people who have nothing left to lose, often tend to lose it. And so it's just, they're trapped. They're trapped. The politicians are trapped. The central banks are trapped, and they got to keep going. And so the way to protect yourself and to understand where we are is to not follow the crowd, but to figure out, to realize what's going on and to try to find a way to get off the path slowly. Now, one person can get off this path. 100 people can get off the path, but the entire army cannot get off the path because it can't. It's too many. And so, and that's where we are. And that's why they're doing it.
As you talk about protecting yourself, Simon, if we think about trying to protect our own portfolios or our own pensions, there are three properties that you talk about that gold has inherent in it. And so why don't you tell us what those are and why they're so important? Well,
when I started thinking about this, probably in the around 2003, 4, 5, after the 2000 crisis, and came to the conclusion, and at the time my business was I was in the hedge fund business, and I had a hedge fund firm that specialized in structured credit, distressed credit, and structured credit, which was at the heart of the last financial crisis. And trying to figure out how to position for this professionally. Personally, I also posited that given what I thought professionally was potentially an existential crisis for the financial system, which it proved to be, and for reasons that everybody knows, the bailouts, money printing, we were able to sort of gloss over, I guess, or double down on what happened in '08, which is why we're facing the same type of event, even worse now. I started thinking from a personal standpoint, how do I sequester a portion of my savings, if you will, in a format that would be independent and somehow decorrelated from what might happen to financial instruments, financial assets in the financial system. And the three, what you just said, I mean, the three principles or the three attributes, I guess, that make gold what it is, and I came to the conclusion that that's why gold was the answer for me, and probably for a lot of other people, and has been an answer for thousands of years worth of human generations, is that it's independent, and we will get into what exactly that means. It's independent, it's lasting, it's permanent, and it's scarce, genuinely scarce. Because clearly, digital claims on various cash flows, streams, and assets, as we know, are not scarce anymore. Although there is such thing as digital scarcity, and we can talk about that. And so independence, scarcity, and permanence. Some of these are obvious, some of these are not so obvious. Like, let's take independence. Now, what is that supposed to mean, independence? First of all, just as a general proposition, independence, freedom, those types of concepts, the highest value that people place on them, on these types of things, is when they lose them. I mean, nobody in the West puts too much value on freedom and independence. I mean, they say they do, but they actually don't. And I understand why. I mean, if you've never been hungry, I mean, how would you know what that feels like? So if you've always been more or less free, how would you know what bondage feels like? How do you know how much you would pay for not ending up in bondage if you don't really know what it feels like or what it is? Now, I grew up in the Soviet Union and escaped from there, or immigrated from there in 1978 with $100 in the suitcase. So I know what it's worth. And we were willing to get people who did that at the time when we did it, basically gave up everything. They gave up careers, property, money, relatives, citizenship. You had to give up your passport. You have to pay for all that. So the cost of freedom was priceless, and people were giving everything, were willing to give up absolutely everything for it. But to get that level of thinking, you have to kind of experience in real life, in personal experience, in personal terms, what that means. So independence of gold, to me, is incredibly valuable. That is a property, however, that most people do not value very highly at the moment, but I think they will as events unfold. Now, what do I mean by it being independent? Gold is independent in the sense that it's a physical item. It's, this is a coin, but it could be in any form. It's a tangible thing. In itself, it's a primary element, atomic number 79. So it's a molecular element. It does not depend on anything. It is what it is. There's no network. There's no infrastructure. There's no financial system. There's no counterparty. There is nothing beyond it. What I'm holding in my hand this is it. There's no other ecology, infrastructure that needs to exist for this to be what it is. Is that important? It's only important if there's a problem with the other things, with what exists. So let me give you an example. So for example, this is a cellular phone, which is a communications device. It's a very valuable device. But for it not to be a brick, there has to be a cell service. There has to be Wi-Fi. There has to be infrastructure, energy spent, technology, software, hardware, system. Some system. It's not financial system, but there's a system that needs to operate for this not to be a dumb hunk of plastic and silicone and whatever. Nothing needs to exist for this to be what it is. And that gets into the second thing, lasting nature. Because it has nothing associated with human endeavor except for itself, it has lasted thousands of years. Empires come and go, systems come and go, technology comes and goes, preferences come and go, everything comes and goes. But this thing remains because it doesn't need anything. It's just a dumb hunk of metal. It's, it happens to be gold and it happens to have certain properties as opposed to some other metals and commodities, which makes it valuable in addition. But those three factors are the key. Now, and the next one is scarcity. Well, it's physically scarce because it cannot be multiplied. I mean, alchemists, people no less talented than Newton himself, Sir Isaac Newton, have dedicated years and years of their intellectual endeavors to finding a way, alchemy, to produce gold out of base metals. It's not been successful. So it is naturally limited. Mining is expensive, it's difficult, it takes a long time, it requires a tremendous amount of effort, and frankly, it only adds, 1.5% to the existing stock of gold. So additional supply of gold inflation, if you will, is extremely, extremely predictable. Now, people talk about asteroids and gold on the moon and then the solar system. That may be a game changer, but I don't expect that to happen in the foreseeable future. And so for now and for the foreseeable future, we are where we are. And so those are the properties that gold has that really no other financial asset has. The other thing that gold is, in terms of financial instruments, it is the only financial asset that is independent from the financial system. I mean, all other financial assets are dependent on the financial system. Like, you cannot negotiate a high-yield bond at a corner store. There has to be, you can.
Yep.
You cannot negotiate your shares in GM on the street corner. You can't. But you can do this with gold. You can do it with other items, but gold simply is the most efficient. It's like the lingua franca of barter, if you will. It's the common denominator for barter exchange of goods for goods. That's really what it is. And it evolved that way because of these properties that I've just described. Now, how valuable they are, it depends on alternatives because everything is in the context. Of course, when dollar is a hard currency, I'll give you an example. For the past 40, 50 years, there have been many hyperinflations. Russia, Yugoslavia, Zimbabwe, Venezuela, Argentina, Brazil. The list goes on and on and on and on. So why haven't people used gold if it's so valuable? Well, because there has been another quote unquote hard currency that's more convenient, and that's the US dollar. For all these decades, people who fell into that situation went to dollars. So, for example, Russia in the early 1990s, when the ruble suffered hyperinflation, essentially became a dollar-based economy. You could go in a restaurant, all the prices were posted both in rubles and in dollars. You could use dollars to pay for everything. The thing to ponder now, if the dollar itself is potentially compromised, what's the alternative? And this is where all the ideas are coming: Bitcoin, other cryptocurrencies, gold, and other stores of value. But if dollar became compromised, that would be a very difficult pickle. We have not been in that situation, not in our lifetime. And that's where people would have to stay. That's where the properties that gold has become extremely valuable, where right now, not a very high value is being put on them.
Mm-hmm. So, Simon, as we talk about gold not relying on financial markets and institutions, how do you think about the broken pricing mechanism that is, let's say, the COMEX exchange? How do we think about the pricing mechanism of gold right now in this day and age, and why it does necessarily rely on that financial market? Well,
very important. The context is very important. The past 25 years, and that's a separate topic that could take hours. Mm-hmm. The topic of financialization. Financialization essentially is a combination of derivatives with leverage. It's taking the speculation and investing and ownership of various claims on different types of assets and cash flow streams into a completely different level. And we've seen that happen because of technology. You cannot have derivative markets without technology. So this essentially has enabled the levels of leverage, the levels of speculation, the volume of speculation to reach, levels we have never seen in history before. So when we talk about the price of gold, and we talk about gold in general and gold investing specifically in today's context, I think it's important to understand that what we're talking about is the price of gold on the screen that we see every day. So it's the property of gold as a speculative asset. Now, just like in the cattle ranching, there's cattle ranching, and then there are cattle futures. Now, everybody inherently understands that cattle ranching, growing cows and then producing beef and packaging it and distributing it, selling it, is a business that really has nothing to do with trading cattle futures. You can have price for cattle futures that is whatever it is, but if you don't have real cows, you can't get a cow for the price that you see on the screen because you can't. It's the same thing with gold. So the question is, what drives demand for physical gold versus what drives demand for exposure to the speculative gold or to gold price? Now, so one is trading and speculation. The other is fundamental and something else. So first of all, we do know, it's not a conspiracy theory, we do know that paper gold markets, derivatives gold markets, have been heavily manipulated by bullion banks. It's not a conspiracy theory, it's a fact. In fact, JP Morgan has just paid $1 billion fine precisely for doing that, manipulating gold market. And Deutsche Bank has paid the fine, and other banks are in line probably to pay the fines as well. Now, why is physical gold available for quote unquote paper price? Demand for physical gold is driven by confidence in for physical gold. Is driven by confidence or lack of confidence in the financial system, financial arrangements, counterparty risk, sovereign risk, political risk. How comfortable do people feel with owning claims, paper claims, digital claims, on cash flows that may or may not appear, the value of which is uncertain, versus having certainty, versus having something? The other property of physical gold is it does not have impairment risk. It is what it is. It has volatility risk, it has price risk, but it does not get permanently impaired. In other words, its price may decline and then it may recover, but it's not like a bankrupt company where the stock pre-existing bankruptcy simply gets canceled. And if you hold it, there's absolutely no way. You have nothing. You have claim of nothing. Because gold is not a claim, but a thing. It does not get impaired. Now, one way it can get impaired, it can get stolen from you physically. They beat you up and they take it away. Then it's impaired. But short of that, it doesn't get impaired. So interest in risk-free, in this way, asset, if you define risk this way, because in the financialized world, a lot of people define risk as volatility, which is the price fluctuation up and down. And if you're leveraged, that may very well be the definition of risk, because if you get closed out on a margin call, you also don't have an opportunity to recover. The markets may, but you won't. But if the risk is permanent impairment, which is the ultimate financial risk, it is the risk, is actually losing your money without ability to retrieve it, or you're losing value without ability to retrieve it, then gold does not have that risk. So demand for an asset without that risk is inversely correlated to the confidence in the soundness of the alternatives to it. So long as demand for it is sufficiently low that it can be satisfied at the price that you see on the screen, paper price and physical gold price are the same. In a situation where demand exceeds physical demand, exceeds physical supply, then the physical market develops its own price. Mm-hmm. Now, at that point, gold becomes deficit good, a deficit good. Now, I'm very familiar with deficit goods. I grew up in the Soviet Union. There were plenty of deficit goods. And the dynamic of deficit goods is that you can have a suggested retail price, but if there's no unit to be had for that price, then the black market sets a different price. It's a free market based on supply and demand. So for example, when I was growing up in the Soviet Union, Levi's jeans were selling for 170 rubles, which was like, I guess it's about a salary of an engineer in a month.
Wow.
At a black market, at an official exchange rate at the time, Soviet official exchange rate, that would be about $180, where at the time, Levi's jeans were selling for, I don't know, $12 or $13 in the United States. So, okay, you can have a, suggested retail price, but it doesn't mean anything. It's the same thing here. It's pure supply and demand, and it's pure market-derived price. So as long as the demand for physical gold does not exceed supply available at the paper gold price, status quo prevails.
So as we talk about the three inherent properties of gold, Simon, I'd like to move a little bit to something you and I talked about before we hit record here, is the debate that we've, been having on the show and that is at the top of everyone's mind right now is gold 2.0 or Bitcoin. So what are your thoughts towards if that role of gold, those traditional roles of gold, are at all replicated by Bitcoin?
Bitcoin and cryptocurrency in general come from the same yearning that desire to own gold comes from, which is to gain some independence from the current financial system, the current fiat currency system, central banks, financial institutions, financial markets. So in that sense, I would say that Bitcoin is a solution to a problem, right? Or it's an attempt to achieve a solution at a problem, just like gold is a solution to a certain problem. I think there's a tremendous amount of marketing hype, misconception, misunderstanding, whatever you want to say, about what Bitcoin is, what it isn't, and about what gold is and what it isn't. So just to start with, digital gold is like digital steak. It's a non sequitur. Gold is not digital, and digitizing gold changes fundamentally its properties, where it becomes something else. It doesn't become something worse, it becomes something else. So the first thing I would say is that digital assets versus tangible assets are inherently different. My thinking about, obviously I give this a lot of thought. And just for disclosure, I own some Bitcoin, I have an investment in it, but I think of it more in a similar vein as I do about gold stocks, which is it's a speculation on some future events that I believe may occur or will occur. But, certainty and belief are not the same thing, right? There's no reward without risk, if you will. So I think that there's a tremendous amount of misconception, which is rooted in this idea of not misunderstanding, but of misplacing value on these three properties, or having a different view of value of these three properties that I said: independence, permanence, and scarcity. Right. So let's talk. So a lot of people say, well, a lot of arguments back and forth have to do with things that are temporal, meaning current but may change in the future. Like, well, they say Bitcoin is very volatile, therefore it's not a good store of value. It's too, it goes down, up and down 20%. That may change. That may be growing pains. That may change, and Bitcoin may come to be very, not volatile and very stable store of value. But it may not change. We don't know that. That's a bet. I heard one of your guests say, well, Bitcoin is lasting. Well, is it lasting? We don't know whether it's lasting. It's lasted 9 years or 10 to 11 years or whatever it is so far. But, even in the scope of human life, that's not lasting. And if we know anything about human history and technology and innovation, it being a technology, it's more correct to say that there will be Bitcoin 2.0, 3.0, 4.0, and maybe it won't be even called Bitcoin. It may be some other coin that proves to be better. We don't know that. But we do know that throughout history, no technology has remained constant for a long period of time. That it's an evolutionary process as opposed to, constant. So the question is, what are the inherent differences? In other words, those differences that will not change, that can never change, between gold, let's say, and Bitcoin, or another cryptocurrency, any digital asset, really. It's not the question. So the first thing is independence. As I just said, I showed you the coin and I said it's completely independent, and then I showed you a phone. Okay, and so my crypto exchange account is on this phone, and of course my ability to trade, transact, access, transfer depends on this machine's access to the network's infrastructure. Okay, do you feel comfortable? Do you think that infrastructure is infallible? It's a belief. It may or may not be infallible. Now, I can say that this thing doesn't depend on any of that, and so because it's not dependent on any of that, it is inherently independent. There does not need to exist a financial system. There does not need to exist electricity, internet, and in fact, none of these things existed when gold became what it became. And if they all disappear tomorrow, God forbid, it will still exist. Now, it may not be a likely scenario, but to say that it's not possible, I think, is fanciful. It hasn't happened in our lifetime, doesn't mean it won't happen. Scarcity, digital scarcity. Well, digital scarcity is a new concept. Bitcoin is scarce, but Rembrandt is scarce. There will never be, Rembrandt has passed away. So for the past 300 years, no one else can create a Rembrandt. But there's Van Gogh, and there is Picasso, and then there are other valuable painters. So maybe Bitcoin is one of many. Maybe it wins the competition overall, or maybe it won't. Maybe something else will arise to displace it or exist pari passu with it for some other purposes or capacities with some other properties that are better than Bitcoin in many ways. So inherently, there will never be another gold in the natural world. There is no other molecular structure like there is a molecular structure of gold. It is what it is. Where there could be other Bitcoin, there could not be another. The Bitcoin itself is maybe scarce because of the algorithm, but it doesn't mean that there's no substitution and something else doesn't have better properties in the future and doesn't displace it. Permanence. It's the same idea coming back to the same thing. There's no technology that we know today that has not been improved upon and has not evolved and has not been better and bigger. So what is the cryptography of Bitcoin? Can it be broken? Well, I don't know. Maybe next generation of quantum computing may break it. And if so, then we're going to have to get a bigger boat, which is going to go to something else. So I think that there is a difference between, again, certainty and promise. As a financial speculation, Bitcoin offers tremendous promise. As a technology, it has promise. As a way to store value and transact, it has promise. But that promise is yet to be fulfilled. It's not a sure thing. And that's why it's a speculation, not in a negative sense of the word. It's a bet on something, I apologize. It's a bet on a thesis that many people believe to have already happened, but it hasn't. And the differences that I just outlined are inherent, and they will never change. No digital asset can exist in the absence of ecology. You cannot transact, even though you can transact Bitcoin peer-to-peer, the mining has to exist. The network has to exist. The transactions have to be validated. The other feature of digital assets versus physical assets is record keeping. Well, that's a very valuable attribute in some cases, and it could be a big detriment in other cases. So, for example, just the idea of a black market, again, not in a negative sense, a black market is a market, unofficial market. Market between individuals that are willing to transact for whatever reason because they don't want the government to know about it. And there may be good or bad reasons depending on how benign or pernicious the government is. Why is it a good idea that all digital assets, for that particular purpose, why is it a good idea that all digital assets, and particularly Bitcoin, has, or cryptocurrencies, have immutable, unerasable database where every transaction is recorded in perpetuity and can never be, and this record can never be expunged? That's not a positive. It's a positive for something else. If you want to record your claim to the real estate, instead of buying title insurance and having some insurance, you can buy and have your transaction recorded on the blockchain, so it's public record that you own it and nobody else owns it, and that's great. That's a great application. But if we're talking about a safe haven, particularly in a situation where government may take a dim view of this, and I think they will actually, because the Bitcoin idea is a great idea until the government decides that it's challenging its primacy on currency issuance, and at that point, it can become problematic. And in that environment, why is that a good idea? That there's an unexpungible record, and the only thing that stands between you and the government unpacking that record and coming after you is cryptography, which is a technology that can 3, 4, 5, 6, 7, 8, 10 years later can be superseded by better technology and broken. And now they say, well, you haven't paid taxes for the last 10 years. Here's the bill. Why is that a positive? So I don't think it's a positive, but that's inherent property of that ecosystem. So one has to decide whether it's valuable or not. Now, there are benefits. Well, the benefit is it's a lot easier to transact digitally than in physical world. But convenience and safety don't always go together. Sometimes they go together, sometimes they don't. So there are environments where digital assets have advantages, and there are environments when they have major disadvantages. Then the question is, what is your thesis about where we're going? What kind of environment are we heading into? So I think there is a cognitive dissonance to say that we may be heading into a very difficult environment where there's social strife, political strife, things like capital controls, currency collapses, depressions, and at the same time be comfortable with assets where the record keeping is immutable and permanent. That may not be a good thing. Where you depend on some infrastructure to exist and your ability to access that infrastructure where it may or may not exist, or may or may not be accessible. By the way, just on that point, the United States Department of Defense puts cyber risk as the #1 strategic threat to the United States, ahead of nuclear threat and terrorist threat, for a good reason. Modern life entirely depends on cyber infrastructure. I mean, there are examples just this week where schools in Baltimore are closed because of a cyber attack for several days, where a hospital in Vermont got cyber attacked and they were unable to accept patients. They didn't know who was supposed to get what test, who had which appointment, complete disruption. So I think that's important to understand that. Again, this is not an argument against Bitcoin. This is simply a realistic assessment of what one thing is, what it is and what it isn't, why it may be valuable in certain circumstances and not in other circumstances. So it all depends on what you think and why you think and how you think, and whether it's certainty or whether it's promise, and what you're willing to pay and how much you're willing to wager. That's really easy. So gold is not a wager. I mean, people who speculate on gold price are making bets. People who own gold as a safe haven, as insurance against mayhem or against restructuring of the financial arrangements, against potential government pursuit or expropriatory policies, they're not looking for a wager. They're looking for certainty and safety. And gold has a time-tested record of that, whereas Bitcoin has a record, but it doesn't have a proven record. And that's the difference. That's,
As you say, like the time-tested record for Bitcoin just simply isn't there to be able to compare it to gold.
It's an observation. It's not a projection.
Mm-hmm. As you and I were talking about earlier, pricing does a lot for sentiment, right? Amazing.
The last time we saw this gold 2.0 and whatever idea was in 2017 when Bitcoin price was rising. Now, this is not related to Bitcoin. If you look at the charts, you will see that the demand for gold ETFs, which is which is digital gold, that is digital gold. Gold ETFs, the demand for that in the Western world, and it's purely a Western product, gold ETFs. So in the world of financial investing, demand for gold ETFs goes up when the price of gold goes up and goes down when the price of gold goes down. Now, everybody knows that, for example, and I don't want to, it's not a comment on men, women, or preference. It's a vivid example. There are certain brands that have, where people who like those brands have confidence in the value of the brand. So if Louis Vuitton were to put their merchandise on 50% off, people who love Louis Vuitton are not going to question and wait till it goes on a sale 60, 70% off. They're going to buy 2, 3, 4 of whatever it is they like right then and there, right? Because they have confidence in the long-term value of this brand. So in Asia, for example, where they have confidence in the value proposition of gold as a saving mechanism, when the price of gold drops, demand for physical gold goes up. In the West, when the price of gold drops, demand for financial products pegged to gold price go up. But when it drops, goes down. So it's it's like buy high, hoping it goes higher. It's just a completely different way of thinking about it. And we will be in this financialized mindset until the markets reset, which I believe they will, in real terms anyway.
It reminds me of that quote of the stock market being the only place where when things go on sale, people get away from it.
Of course, yes, of course, because they have no confidence in the value proposition. They don't have confidence in the value proposition. That's really the issue here. So when people have confidence in the value proposition, as they do in Asia, they act in the opposite, and that's a normal way to act in that situation.
So Simon, one of the important points that I'd like to hit here before we wrap up, we've hit a lot of my questions and everything. So one of the things you talk a lot about is the value of recognizing propaganda, and with your background, you've obviously seen a lot of that. So tell us a bit more about how you think about that, and maybe give us a couple examples if you wouldn't mind.
First of all, propaganda is not a dirty word. It's been made a dirty word. You have to understand, if you understand what propaganda is, for example, the word propaganda comes from Italian. It's the name of the Institute of Jesuits for the propagation of faith. So it's a spreading of the word. Where I grew up in the Soviet Union, the number 2 official in the Communist Party was, so number 2 after Brezhnev, while I was growing up, was a man who was in charge of a department. And the name of that department was the Department of Agitation and Propaganda of the Communist Party of the Soviet Union, in black and white. Agitation and propaganda, spreading of ideas. So propaganda is a spreading of a specific view. It's not news, it's marketing. It's a marketing pitch presented as news, right? Presented as fact. So critical thinking and triangulation are the only ways to see through that. Is that what they're telling you? So the way the Soviet people finally got to it is when every 5-year plan was fulfilled and overfulfilled, but the shelves were bare. Eventually, people got to the idea that what they're telling me is not what's happening. They're telling me that I'm living in this Shangri-La, but I can't buy shoes for my husband or my wife or whatever. So clearly, there's a disconnect between reality and what I'm being told. And it's the same thing here. It's not Bitcoin propaganda, but marketing, depicting digital asset as a physical gold coin is obviously an attempt to present a view that doesn't comport with reality. Now, whether it comports with reality or doesn't in a good or bad way, it's not reality. It's not what it is. Saying that it's gold 2.0, that it's digital gold, that it's this gold. Have you noticed that everything is based on gold? That all of Bitcoin marketing is based on how it's better than gold. It's different kind of gold. It's gold this and that. There's a reason for that.
There's a reason it's the benchmark.
Because exactly. They're benchmarking. There's no other benchmark that you can benchmark against. So this is what they benchmark. So by putting down gold, they're essentially making the biggest compliment to it as they can make. By they, I mean promoters. I don't mean just Bitcoin owners. There are people who own it for reasons perfectly, sound reasons, knowing what it is and what it isn't. And then there are people who promote it, like with any investor. There are people who promote gold and make all kinds of claims about it, which, some of them are very fanciful. So that's the difference between promotion. It's the same thing what we see on the news. Is it true? Or is it what you want to hear? So, for example, in the Soviet Union, the way you knew propaganda from not other than just by experience, well, there were alternative sources of news. So, Voice of America. In fact, the Western nations have invested billions and billions of dollars into bringing the alternative view towards against Soviet propaganda, so that Soviet citizens could get different point of view. So, Voice of America. The Deutsche Welle, which was the German radio station, Radio Free Europe, Radio Liberty, Call Israel, which is the Israeli station. All those sources, the magazine called America in Russian language. All of those were Russian language sources of information which presented an alternative view to what the Soviet marketing pitch was. And so people, and of course, the Soviet government tried to douse those sources by jamming those broadcasts. So you had to work hard to get that information. It's the same thing here. When you're being told something, think critically. Don't take it at face value. Listen to the other people. Maybe the other people are pitching completely opposite thing, and they're also propaganda, just the opposite propaganda. Triangulate. Get multiple point of views on the same thing, and then make your own decision. There's really no other way to get around it. This is where democracy places responsibility on each citizen to ferret out the truth from the noise and the stream of sales pitches that are presented to you by people who are, benefit from you believing in their way, who have an agenda to tell you what you should think, whether it's true or not, whether it's fact or fiction. There's no other way. It's also, the other thing I have to say, it's very difficult to implement, but I've been sort of fortunate to have a pretty strange background. I mean, I grew up in the Soviet Union. I've seen repression. I've seen currency collapse. I was already here when it happened in Russia, but I've had friends and relatives there. So I've traveled there, not in many years, but in the early 90s, I went back to see what's going on. So I have that. My first college experience, engineering, so I understand science. I then got a degree in political science, so I understand government. History is my hobby. My graduate degree is in finance, and my experience has been in investing and structured credit and derivatives and CDOs and all the technologies that basically brought us to ruin. The financialization technologies that brought us to ruin. Fortunately, able to recognize it very early in the early 2000s and profit from all of that. But nevertheless, and so some things that I may perceive, other people don't perceive, which is why I'm happy to educate and to explain and to share this knowledge. But it takes multidisciplinary approach and perspective. We're facing a very complex problem, and a very complex problem requires multidisciplinary approach to solutions. It's not this or that. We have political issues, we have social issues, we have financial, economic, geopolitical. It's a real complicated cluster situation, if you will. And you can't use one screwdriver to fix all the, it doesn't fit every screw head. Mm-hmm. So you really have to have a toolkit. And that's why I think it's important. So if there's a message, history, perspective, learning from different environments, understanding different environments, what if analysis. So what if this happens? What if that happens? Don't dismiss it. Many people, for example, when gold is discussed, Armageddon. So you're talking Armageddon. Well, every empire has come and gone. Every fiat currency has come and gone. Every financial has come and gone. And the human race perseveres. Armageddon is the end of the world. No, these are the end of financial affairs of certain people. This is where rich people become poor and somebody else becomes rich and the world goes on. I think that's the perspective with which one needs to look at it. And as somebody with savings, the real task here is not to win a prize. The real task here is not to get sunk, with whatever is going to happen and to persevere and continue for the sake of oneself, one's family, one's future. That's really the approach that people should take. Mm-hmm. And that's how I look at it.
Well, Simon, I think you've added a lot to the conversation here, and that's something that's always my goal in doing this show, is to really try and show different opinions, show different sides of the coin, and really make sure that we're not just sitting in an echo chamber, to look at this from all different sides, and, as you say, try and triangulate our thinking on this industry and where it's going. Simon, why don't you tell us a little bit about the Bullion Reserve and other places that our listeners can find out more about you?
Well, sure. It's Bullion Reserve is simply a platform, or whatever you want to call it, is a legal vehicle that I designed or developed out of a personal experience with trying to own gold, hold it in non-financial storage facilities, or initially in a bank. And when that didn't work out, I realized that just like with anything, as soon as you get at some critical mass level, you need infrastructure, you need understanding, you need access to various providers that can do things. And so I created a solution initially for myself and then for other people that allows high net worth individuals to essentially access commercial bullion supply chain, which is refiners, secure storage facilities, transportation facilities that are not normally available to individuals, only available to commercial entities, and make it available for individuals and relationship networks and so forth. It's a actively managed contingency plan, if you will, that stores gold outside the financial system and commercial infrastructure with compliance and all the necessary attributes, financial controls, fiduciary controls that we expect in financial affairs, but typically don't translate into commercial businesses and commercial arrangements. And so since I've been in the investment business and handling institutional money and other people's property for basically my entire career, I brought these, it's a multidisciplinary thing, where I brought multiple disciplines to this solution, taking the best of each and creating something that I think makes sense. It doesn't make sense for everybody, but for some people who appreciate this particular way of doing things, it makes sense, and that's what we do. And bullionreserve.com is the website, and you can check it out.
Sounds like you're just trying to help people be their own central bank, right?
It's basically what it is, right?
Yeah.
It's being your own central bank, but with the contingencies and relationships and the attributes that are important for these types of affairs, because everything works. Like, there's no problem with owning a gold ETF when everything's fine. I mean, it's perfectly fine right now. You can speculate. It's easy to buy, easy to sell. You can do it all from your phone. It's when things go wrong. And so to the extent, again, it all depends on why people are doing it. If they're looking to speculate or to trade gold for profit, then what we do is not for that. Mm-hmm. If they're looking to create reserves, which is why it's called Bullion Reserve, if they're reserves for contingencies and planning for those contingencies and thinking about those contingencies and how to overcome obstacles that are not here today but may arise in the future, then that's what, it's like insurance policy. I mean, it's easy to call an agent, buy insurance, but when the loss happens, that's when everybody starts reading and find out, oh, well, this isn't covered, or that isn't covered. Well, I never read that. I didn't know what's covered and what's not covered. Well, if you go to the industrial setting, people who buy insurance for factories, I mean, they know what they're doing. They go through all the contingencies. They negotiate with insurance companies about what's covered and what's not. It's not a boilerplate. And so it's the same thing here. It's just structuring a plan that makes sense and then can evolve, and people who are competent to notice that it needs to evolve and evolving it as it needs to happen. That's what it's about. It's not a mystery. There's no magic anything here. Hard work.
Perfect, Simon. Yeah. You're also S. Mikhailovich on Twitter, and you do post
S_Mikhailovich.
Sorry, yeah, S_.
Yeah, no worries.
Excellent, Simon. Thank you very much for your time and your thoughts today.
You're very welcome.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.